All right, how's it going, everyone? So I think I found a stock that probably is not on anyone's radar or watch list. And the best part is they have an economic moat that would make the French jealous. And I'm being serious because when you think about the French, I think the only reason why they were able to resist and defend themselves from the Viking raiders, back in the 8th, 9th, and 10th century is because of their economic moat. Or not the economic, but the water moats that they had all over their cities and especially around their strongholds and castles. But stepping aside from a historical lesson and coming back to this financial video, what exactly is an economic moat? That's a really good question, Jerry. Well, I'll tell you. An economic moat comes in a lot of different varieties and flavors. You got your intellectual property patents. They're the only ones that do what they do. Their economies of scale. It's so much cheaper for you to do business, or you have like 50 fulfillment centers while your competitor only has like 1 or 2, which means you're able to do business in a more efficient manner, and etc., etc. However, if you take a look at your screen right now, all the way at the bottom, regional dominance, regional monopoly. They're the only ones that do what they do in that territory, area, or whatever it is we're talking about. That is this company's economic moat. Today, we're going to be talking about YORW Water Company, ticker symbol YORW. And we're going to review the company's story, financials, and fundamentals to see if they are a dividend compounder or not. So if you're curious to find out and you're dying to know what's going to happen, then keep watching. So when we think about YORW Water's share price total return from 1999 to today, well, you would have yielded 443%, meaning their stock price has 4x'd in a span of 26 years. That's not taking into account the dividends. So how exactly is this video going to unfold? So on the left side of your screen is the table of contents. So you can go ahead and skip around to whatever fancies you. And it's going to be on the pinned YouTube comment as well. So you can just click and go to where you need to go. So without further ado, let's go ahead and talk about their business overview. How do they make money, and what's their biggest growth driver going forward? So YORW Water Company, as the name might imply, is a water utility and wastewater treatment. They service over 210,000 people over 57 counties in the state of Pennsylvania. And what's interesting about this company is that they get their water source from a handful of different places, right? We're thinking about the Quidorus Creek, Lake Redmond, Roxbury Dam, and they also have a handful of wells as an emergency source that's able to provide over 900,000 gallons per day. In case anything hits the fan and they need to hit the reserves, they do have a reserve vault of water available as well. So how exactly do they make money? Well, in 2024, their operating revenue was derived from the following sources. So residential, so people like you and me, 64% of their revenue. Commercial and industrial people, 29%. And the last 7% are from the various fire departments in Pennsylvania. I think between you and me, their diverse customer mix, I think it helps to reduce volatility. Because if they were all in 100% revenue just from the fire departments, imagine if their budget gets cut 1 year, whatever, that means their budget is also going to be cut. Does that make sense? But because it's diversified across different streams, I think they're okay. And their biggest growth driver going forward is the increasing number of customers through acquisitions. So this is a company where they grow through acquisitions. So basically, YORW Water buys out the competition and adds whatever they were servicing to their portfolio. And because YORW Water is a regulated utility, their profit and margins are pretty much set in stone. They can't squeeze the consumers. However, very soon they're going to push for an increase in their rate. I think they were talking about it like last week or whatever, which means they're going to get more money from each customer that they service. All that to say, I think it's worth calling out that YORW Water is not the only ones that do what they do. Because remember, they only service Pennsylvania. So what you see on your screen right now are all of their different peers, rivals, and competitors that do exactly what they do, but in different territories and regions of the US or abroad. And now let's go ahead and talk about the arguments against YORW Water. Well, number one is a disaster event. The expectation for this company is clean water from their customers, right? However, when you think about it, keeping something clean and pure and clear, it's difficult. So what if, this is a big what if some kind of like toxic material or some kind of industrial company starts to dump stuff into the water sources of YORW Water Company? If that happens and then YORW Water is found guilty of supplying that kind of water to their customers, dude, it's going to lead to unexpected fines and fees. This is plausible, okay? Number two is their CapEx spending. Some people understand why CapEx is necessary, and other people, they hate it at all costs because they don't understand that CapEx is necessary for growth and in increasing the revenue in the future. Some people are very short-sighted. The third argument against YORW is a potential drought, aka climate change. I'm not asking for your political opinion, Jerry. This is just straight from their 10K. This is what they're saying, okay? So on November the 1st in 2024, the Pennsylvania state officials actually declared that there was going to be a drought watch for 33 counties in Pennsylvania, and that included all 4 counties that YORW Water actually services. So if that happens and there's a drought, that means through consumer behavior or encouragement, they're going to use less water, right? And their numbers show that 5 to 10% of the people actually reduced how much water they consumed in that time period. All that to say, in the future, if there's more droughts that are declared and that are on the map, that means that's going to reduce their revenue by 5 to 10% each time. So that is something to be mindful of. So enough with the negative Nancy, and let's go ahead and talk about the bull case going forward for YORW Water. Like, what's the positives going for this company? Number one, I have steady cash flow. It's a very easy to understand business model where the cash flow itself is very predictable and reliable. Because when you think about their service or product, which is water, it's not like oil or selling an iPhone. Water is something that everybody, including your wife's boyfriend, needs on planet Earth. Unless we become like those people from the novel and movie series Dune, dude, water is here today and it's here tomorrow. Number two I have is their dividend history. They have a clean and stable dividend history, actually 209 years of consecutive dividend payments. Not once in any economic recession or downturn did they get rid of their dividend. 209 years of consecutive, consistent dividend payouts. That's actually pretty crazy. For me, based on all my research on the different stocks on the stock market, I think that takes the cake. I don't think there's anyone out here that's going to beat them. And number three is insider buying. So the entirety of 2024 up until right now, the time of making this video, the executive leadership team has been buying up shares of YORW Water Company. This includes the CEO, the CFO, the directors, and vice presidents. Think about it like this. This is why I think this is a bullish case for YORW. If you work for a company, whatever company that you work for right now, just think about it, okay? And you know that the future looks bright and their stock price is undervalued, what are you going to do? Are you going to buy shares? I think it's pretty simple math. If all of the leadership within a company is buying up the shares, that means they know something that we don't, and they think it's an opportunity, a buying opportunity. Unless, of course, everybody within your company, bunch of idiots with pepperoni nipples that are just doubling down on a sinking ship, but I highly doubt that. And their economic moat, I want to touch upon this, okay? I know we talked about it in the introduction for this video, but it's the competition. They have none. It's a regulated utility, which means they have a monopoly in their territory. That is their economic moat in the state of Pennsylvania for the counties that they service. And I think that's a pretty awesome thing. Unless, of course, you are serviced by YORW Water and their rates are just crap and they just overcharge you every month, then these guys are pigs, they're pieces of crap. But I wouldn't know. Okay, I'm a Seattle guy, born and raised in Virginia and California, so I don't really know anything about the state of Pennsylvania. So for all I know, based on what I've read, I think they're good people because according to them and their annual report, their customer satisfaction is pretty good. It's above the competition when they compare themselves to their rivals. So I'm just going off of what I know and see. All right, so their most recent earnings report and latest updates. So, not good. Their net income decreased year over year. So, the net income is the bottom line because of higher operating expenses associated with maintenance of their equipment and their water treatment facilities. And this is a bummer, okay? The interest rates on their debt, it went up. Also, the company experienced higher depreciation costs of their equipment, which reflects the aging of their utility infrastructure and the need for ongoing maintenance and replacement. That's the nature of the utility sector beast, and that's why their CapEx spending is higher than the other industries. And we're going to talk about that here in a little bit. Now let's go ahead and do a deep dive and look at their numbers and financials, because this is the most important part, right? It doesn't matter if a company has a sexy logo or if they're trending in the news. If their numbers and financials look like crap, as a dividend growth investor that also believes in value investing, I ain't going anywhere near that company. I don't care. I'm actually dogging right now, so we're going to do a speed run through the numbers that I think are relevant and important for this company, okay? So the first one is going to be their price to sales ratio. It basically tells us, is this company have high expectations placed upon them, or is Wall Street bearish towards them? Their price to sales ratio is a 6.1. That is a really high ratio, which means what?
12 seconds later.
Yes, you're right. Wall Street is bullish towards them. However, if you're bullish towards someone, that means you have high expectations, which means if they do anything wrong or if there's any setbacks, it's going to be disappointing, which means a sell-off of their stock price. Potentially, okay? The next thing that's important to call out is their PE ratio, their trading multiple. So right now, it's a 23. You might be like, dude, that sounds expensive. I thought this is supposed to be undervalued. Well, check this out. Historically, for the past 20 years, their PE sits at around a 26.8. Sometimes it's as high as a 30. So right now, they are at a discount because they usually trade for a bigger premium. And the next thing that I want to call out is their earnings per share. Yes, it went down by 20% year over year because we just learned, right? Their net income went down due to all of those headwinds hitting them at the exact same time. And their debt situation, yes, we're going to be looking at the debt to EBITDA. It's a 5. Okay, and you might be like, dude, you always say that the standard is 3, right? But if it's a 5, this should be a red flag. Am I not right? Well, yes and no. It depends on the industry and sector. Remember, this is a utility. So a debt to EBITDA ratio of a 6 or below is the standard. For them, it's a 5. So I don't think it's too bad because the utility sector, yes, there's high loans, there's negative free cash flow, and there's a lot of leverage all around, but it's okay as long as you understand that that's the name of the game. Just like the military stocks and the military defense industry. It's a lot of CapEx and a lot of leverage, but it doesn't mean inherently that their business model was bad. If you know how to utilize loans and make loans work for you to generate more cash or to grow your business or to expand your enterprise, loans are not bad. Unless you operate with that Dave Ramsey mindset thinking all loans are evil, it's just not true. I wanted to make this point because there are some popular YouTubers that are 100% all in. They will sell their soul and their firstborn child for just free cash flow. They act as if they're allergic to debt and loans. And it's just like, dude, you don't understand the business landscape. Loans can actually be a good thing. Whatever. The next thing that I want to call out is, yes, their operating margin went down by negative 9% because remember, higher operating costs, okay? And the return on invested capital right now is a 4.4%. And when you look at it historically, it's usually around a 4.9%. So I don't think that's a big red flag. It's around the same ballpark territory. The return on invested capital for their CapEx spending, it seems to be in line and it's pretty normal. The next thing that I want to call out is the shares outstanding situation. You want to see a company buying back their shares, unless it's a REIT, a BDC, or in this case, a utility. So to answer the question, are they buying back the shares? No. However, it is worth noting in 2012, there was 12 million shares outstanding. No, I didn't mess that up. It is 12 million. That's it. That's a tiny float, guys. All right? And as of right now, there's 14 million shares outstanding. So what you want to know, the important thing here with the shares situation is we learned earlier that anybody who is somebody in the company, they're buying shares right now. Nobody is selling. Pause this video, open up a new tab or open up Safari, whatever you use, Google Chrome, and look it up. Insider buying, YORW Water Company. They're buying stocks nonstop. Nobody is selling. Dude, I got to take a dump. Whew.
2 hours later.
And if you move your eyes to the bottom of the screen, the performance, something that I want to call out is up until the year 2020, 2021, they were a pretty good darn dividend compounder. However, in the last 4 years, obviously the interest rates have been horrific for the REIT industry, for utilities, for BDCs. It's just not a favorable business environment for them. And that's why they lost almost all of their gains in the last 4 years, and that's why they're underperforming the benchmark, which is the S&P 500. And the last thing that I want to touch upon is the dividend profile. Right now, you might be looking at it and saying 88 cents is the total dividend payout. That sucks. But remember, 200 plus years of consecutive, consistent dividend payouts. Okay? They never cut it. And they are growing their dividend for the past 20 years at a rate of 4% year over year. Doesn't matter if the economy is booming. It doesn't matter if the things are crashing and burning. They grow it at a rate of 4% consistent and steady, which is slightly above the rate of inflation historically. And the payout ratio tells us the dividend itself, very healthy, sustainable. And actually for a utility, at 64%, I would say that's in the excellent tier and category. Because usually utilities, if you pause this video and open up Dominion Energy or some other big name utility companies, the payout ratio is usually like a 90-95%. So for them to have a 64%, 200 years of a dividend payout, I think that shows us that fundamentally their operations for the past 200 years has been pretty darn good. Because to pay a dividend, remember, man, the company itself needs to be crushing it or needs to be above average in what it is that they're doing. Because if there's any like negative net income or if they're just having setback after setback, they won't be able to finance that dividend. But this company shows us time and time and again for the past 200 years, they're able to afford and pay that dividend on time every 3 months, every quarter. Case in point, I wanted to show you the power of YORW Company's dividend profile. So let's go ahead and assume that you invest an initial $10,000 into this company and assuming that their dividend is going to continue to grow at a rate of 4% year over year. I think the dividend yield right now is like a 2.7%. And their share price is only going to go up by 5% year over year, okay? Under those assumptions and baked into this calculator, this is what we're seeing. Okay, so the portfolio balance itself is going to be 10 grand. And by the way, you reinvest the dividends that are paid out back into the portfolio to buy more shares. It's called DRIP. So it's going to start at 10 grand. And in that first year, the annual dividend payout is going to be $1,100, give or take, $35. And by the end of the year, the portfolio's valuation is going to be $11,600. You fast forward throughout the years. By the beginning of year 10, your portfolio's valuation should be $38,500. And then the dividend payout should be about $3,900, and the end of the year balance is $44,000. So I don't know about you, but seeing in this hypothetical scenario, my money go from 10 grand to $44,000 in a very boring water utility stock, not bad at all, right? However, this is all speculative because who knows, in the future, they might decide to end their 200 plus years of consecutive dividend payouts and their share price in the stock market might further get obliterated and destroyed and your 10 grand might shrink to like 7 grand. So it can go either way. It can go to 7 grand or it can go up to 44,000. But it's just to show you the powers of dividends and reinvesting the dividends back into your portfolio. So now let's go ahead and talk about how much is YORW Company actually worth. Let's figure out their intrinsic valuation. But before we get to that point, we need to look at their 1 year trading history to see if the intrinsic valuation that we reach is too crazy and too bonkers. Okay, so their 52-week high and low is what you see on your screen right now. $41 a share, pretty much their high, and $29 a share is their bottom. Right now, they're currently trading for about $32, which means, ta-dang, yes, they are near the valley price point. They're at their bottom. Okay, so with all that said, based on the dividend discount model and their dividend growing at a rate of 3.7%, even though historically it's 4%, well then their valuation based on their dividend profile is $37.89. That's their intrinsic valuation. Right now, they're $32. It doesn't take a rocket scientist to know, oh, this company's undervalued. But let's do one more. We're going to do the multiples valuation. So based on how the market values their peers, the median PE ratio is a 25. So if YORW Company had a 25 PE ratio, which is below their historic average, it should be around 26. But let's just go ahead and say it's 25. Then their share price should be $35. And if we average out the two of the intrinsic valuation models, then the true price, the intrinsic inherent worth of this company should be $36.72 a share. Right now, it's 32. Yes, that disparity, the difference between the two numbers, not the greatest, but it is still undervalued. So taking the intrinsic valuation number into account, what is a good value investing price then? If we bake in a margin of safety, deducting a little bit just to have that extra cushion into their intrinsic value price, then I think a good price to buy YORW Water Company, this is not financial advice, a good price, $32.40, which is basically what they're trading for right now. However, I'll do you one better. If you want a bargain price, then we're talking about $28.80. If you want a steal of a price because you want a five-finger discount, then we're talking about $25.20 a share or anything underneath that. Will it reach that price point? I don't know. But will this company hit $30 or even $29 a share? That is quite a possibility based on their history. They just bounced back up from their 52-week low, so time will tell. It's time for the final verdict. What is this company as a grade and as a label? I think as a business, YORW Water Company, it's slightly, ever so slightly above average. Its stock market performance in the last 5 years, absolutely atrocious. But it's the market cycle, right? It's not every single day that the utility sector is going to outperform or do well. And as of right now, they're not doing too hot. It's not a favorable business environment for them because they rely on loans, and the interest rates right now are very high, which means the loans that they do take out, it's going to have a high interest rate baked in, so things are not fun for them. However, they have over 200 years of history of crushing it and staying alive through all the ups and the downs, of all the uncertainty, all the different presidential administrations. They find a way to survive and do well. So taking their history into account, and also the fact that they are on paper undervalued according to their own metrics and valuation numbers, I think their grade is a B. It might even be a B minus depending on how I feel that day when I wake up. Did I get good sleep? Did I get bad sleep? A B, okay? Above average. And because it's a regulated utility, it's not going to be a company that has a sexy and bright future like Microsoft, pioneers of the AI movement. However, as a label out of these three right here, definitely not disgusting. I think it's a very decent dividend-paying business. They're not delicious, because if they're delicious, they got to be outperforming the S&P 500. So they're decent, and they're a B, above average. So what's my game plan when it comes to the YORW Water Company? My thoughts and opinions after looking at their numbers and current situation. So when I think about it, utility stocks, they're kind of like a proxy for bonds, right? It's a type of business that is ideal for someone that is retired, like 65, 74 years old, and they rely on passive income or a dividend portfolio that gives you like $1,000 or $4,000 every single month so that you could use it to buy your Viagra pills or whatever you need to buy. Or for someone that is looking to retire very soon. I think those are the categories of people that would probably find this company interesting. But for me, I know the face might say otherwise. I am in my mid-30s. For me, I still have about 15 to 20 years to go until I retire. And I do love dividends, but I'm not really looking for a retirement dividend stock right now. It just doesn't make sense with my goals and objectives in the stock market. I think you know where I'm trying to get at. Right now, I would like a little more growth baked into my choice of investments, if that makes sense. And I think with YORW Water, the growth, I don't know if it's going to come. And besides the growth variable that is weighing down my decision here, even while considering the landscape of the regulated water stocks, for me, the better water utility company is going to have to be American Water Works in almost every single way. So what you see on your screen right now is the adjusted stock price total return, meaning their share price appreciation with the dividends taken into account. For the past 20 years, them going head to head against each other. And the kicker here is that American Water Works, their history only goes back to about 2008. So YORW Water Company has 2 years of more numbers and compounding going in their favor, and they still underperform American Water Works. American Water Works for the past 18 years, we're talking about a 920% total return. For YORW Water Company, it's 277%. So for someone like me, I would rather invest into American Waterworks. And I'm not just saying that because I am a shareholder of American Waterworks, but it just makes more sense on paper for someone like me. So that's the conclusion that I have reached. I think YORW Water Company is a pretty decent stock for someone that wants reliable dividend income. I mean, it has 200 plus years of consistent dividend payouts to say that, right? To fit that definition. But ultimately, it's a pass for me. All that to say, what do you think? What's your thoughts and opinions on YORW Water Company? Do you like it? Do you hate it? Do you disagree with me? Do you agree? Let me know, okay? I love you guys. Stay safe. Good luck in the stock market. Peace out, A-Town. Oh my gosh, that's cringe. I'm sorry.